So welcome to the review session for the fall 2014 final exam. Hopefully everybody's been studying up. As you all know, the final exam will be cumulative, which means it's going to cover every chapter that you've gone through, and the appendices that it will cover are listed in the syllabus. So for those people who have emailed and said what appendices are on the exam, refer to the syllabus. It's in there. It's the same as the other, exams, and you can take a look and see, what you should focus on. There will be 67 questions on the exam. There will be 45 multiple choice questions. There will, just on the general material from chapters 1 to 12, there will be 5 questions on the worksheet. So if you remember from the first exam, you had a worksheet, so there'll be 5 questions on that. And then there will be 17 questions related to the statement of cash flows. And I think that the professor has hopefully given you that information as well. So I don't know if I'm providing you anything new or not, but hopefully that at least helps. But the distribution of the 45 questions is across all the chapters. I can't tell you there's an emphasis on one or the other, but there's 45 questions and you've got 12 chapters, so think about the nature of the material and focus on the things that you either struggled with on the first 2 exams. If you're trying to figure out how to study for chapters 1 to 9, focus on the things that you struggled with. I mean, a lot of the concepts, and we'll go through each of the chapters here, in the beginning, you build upon them, so you're kind of testing them through other means, but just really focus on the things you struggled with. And then on chapters 10 to 13, make sure you've done your homework and you go through all the problems. For example, go back through all the clicker problems because they're a good check of multiple choice questions. Go through the sample exam. That way it'll at least help prepare you on how to answer multiple choice questions on certain problems. So what we're going to do today is we're going to do an overview chapter by chapter, and I'm just going to highlight, in my opinion, I've taught this class in the summertime, and I've been a TA for this class this is, I think, my 3rd semester now. So these are kind of the topics that I would generally focus on, just so that you have, again, this isn't comprehensive. It's not just focus on these things, but I think it's a pretty good summary, in my opinion, of what you should focus on and look to cover. And then what I'm going to do is I'm going to solve the cash flow from the sample exam, and we'll go through that. I'll tell you about some things I think you should make sure that you understand for purposes of the test. I can't tell you that this cash flow is going to, look exactly like the one that's on the exam, but at least it's another cash flow that you can practice with. And the more you practice, the better you get at it. So we'll do that one together. And then, depending on the time, I'll either go through a couple more example multiple choice questions, just so you have practice for chapters 10 to 13. And then I'll answer any questions. I have the sample exam printed out, so if anybody has any questions on the sample exam for the final, I can definitely do that. I didn't print out the first 2, but hopefully, most of your questions will be on the latter, the final exam sample. I wasn't planning on going over a worksheet. It's kind of hard to go through. If you have any specific questions on a worksheet, you can email them to me, and I'll try and answer them this weekend. But I think there's 5 questions on it, and I think there's there's a example in one of the earlier midterms, so hopefully that'll help. And again, if everyone can make sure that they're on mute so I don't hear background noise, that would be great. And then I will post these review slides online. I think someone had asked if I would post them on Blackboard. I will post them on Blackboard, and I will also post the answers to the sample exam. So hopefully everybody has at least tried the sample exam. I don't think the answers are posted yet, but if they are, okay, that's good for you guys. If not, I'll post them right after this so that you have them. But I think we just wanted to give everyone a chance to try and solve the sample exam. So with that being said, I think I'll get started, and hopefully, again, ask questions as you go. You can type them in the chat box. If you want to ask me directly and come off mute, you can do that as well. So please, don't hesitate to ask questions. There's no dumb question. Anything that you want to know, I'll do my best to answer it. If I don't know the answer, I'll get back to you either directly or through a Blackboard message to the group. So with that being said, I have slides here, and I'm just going over different concepts on these slides. And the first is just really kind of chapters 1 to 4, which is the first exam. And if you think about chapters 1 to 4, those are really the building blocks of the entire course. It goes through the basic accounting entries of debits and credits. How do debits and credits impact the assets, the liabilities, the stockholders' equity, revenues, expenses? What are their normal balances? How do you make adjusting entries? How to do an adjustment worksheet? And, when I think about the exam, a lot of these concepts you build upon in chapters 5 to 13. So, I think that, you have to generally know those concepts, I think, to understand 5 to 13. So hopefully, if you got a good handle on those later chapters 1 to 4 are pretty easy for you, and you can just kind of generally skim through them, make sure you know the concepts and move forward. If you're struggling with the basics of accounting, I would definitely spend a little bit of time, but also don't neglect the other chapters. So again, chapters 1 to 4 are just the basics, and we already know that there's going to be an adjustment worksheet on the final, so I would look at the midterm sample and go through that adjustment worksheet. Then when I think about chapter 5 is where things start to get a little bit more complicated and detailed. And for some people, chapters 5 to 13 actually get easier for them when they go through the specific concepts. And chapter 5 deals with looking at perpetual inventory versus periodic, and how do we record those journal entries related to each, because the journal entries are different, right, when we talk about perpetual and when we talk about periodic. So we want to make sure that we understand, and I think in the chapter 5 slides as well as in the book, there's a good table that actually goes through a summary of what are the journal entries for chapter 5 for perpetual and what are the journal entries for periodic. So I would definitely, kind of look at that summary. It's a really good summary, I think, and it'll help you understand what those journal entries may be. And the things that those journal entries focus on is recording purchases of inventory, including any discounts, returns, freight costs, and how to treat them if you're the buyer or the seller. Also recording sales of inventory if you're the seller of the inventory, again, including purchase discounts, returns, freight costs. So those are pretty important, and again, using that summary, I think would be a really good idea to kind of focus on. And what I'll do is I'll add that to this slide so that you have the reference for what that table is that I'm speaking of. Let me just write that down, and I'll add it to the slides before I post them to Blackboard, just so that you have that reference. And I'll do that if I mention any tables, I'll add the references to the slides so that you have them. I apologize, I didn't do that beforehand. And then the last thing with chapter 5 goes through the multi-step income statement. And if you remember from chapters 1 to 4, we had revenues and some expenses, and we came up with net income. The multi-step income statement really goes through all the different, kind of blows out the income statement. And, we don't just have revenues. Now we've got net sales revenues, where we've got our sales revenues less our sales discounts and our sales returns, and that gives us our net sales, and then we've got cost of goods sold. We take our net sales less cost of goods sold, we get our gross profit, and then we've got our operating expenses, non-operating expenses. So just kind of understanding how that multi-step income statement works and what's gross profit is very important, I think, for chapter 5. Then as we move, and one other thing to note, the net sales, remember that we've got those contra accounts. Like I said, we've got discounts and we've got returns and allowances. I think this should say sales. So let me just change that. And those are the contra accounts to the sales revenue that gives us our net sales revenue. So remember those when we're thinking about the calculation of net sales. Chapter 6 goes through, I think, for the most part, and I kind of highlighted this here, the different inventory costing methods. What's LIFO, FIFO, average cost. So knowing how to calculate ending inventory based on any information given, or cost of goods sold. I think there was a couple problems on that in the last exam. I think there's some sample examples on midterm 2 sample that go through that. And just knowing how to calculate, any of those pieces, be it the average cost of the inventory given the information provided, or, like I said, ending inventory or cost of goods sold. So that kind of covers, I think, Chapter 6. I think that's the biggest concepts in Chapter 6. Chapter 7, I think that was kind of one of the shorter chapters, and I think the biggest thing in there that that is covered is bank reconciliations. So I would definitely know bank reconciliations and make sure that you understand the components. Chapter 8 goes through all the calculations of the bad debt expense and allowance for doubtful accounts. So here, when we talk about the, what's GAAP versus what's not GAAP, remember the direct write-off method was not GAAP and the allowance method is GAAP. When we think about the allowance method, there was 2 approaches. One was the percentage of receivables, which is a balance sheet approach, and then the other is a percentage of sales, which is an income statement approach. So knowing how to calculate that and how to determine what bad debt expense is, and make sure you understand the difference between the two, because I think a lot of people mix up how to calculate bad debt expense based on these 2 approaches. And when you calculate the percentage of receivables and you do the different buckets, the different aging buckets, you want to make sure that you what you calculate ends up being your ending allowance for doubtful accounts. You compare that to the beginning allowance of doubtful accounts, and that's going to give you your bad debt expense. When you have percentage of sales, what you calculate as the percentage of sales is actually going to just be whatever it is the actual calculation. So there's a difference in the 2 that you need to make sure that you understand. The last thing in Chapter 8 is going to be write-offs of the allowance. So those are, I think, the key things for Chapter 8. If I have time, I will do an example of those. But let me see how much we can get through. And if I don't get to it, maybe I'll just post an example online. But let's see if we can get to that here. My name is Amy, by the way. Someone just asked what is the name of the TA. My name is Amy. Okay, so that's Chapter 8. Then we have Chapter 9, and Chapter 9 talks about the cost of plant assets. So what are the things that go into the cost of land, or the cost of a building, the cost of equipment? I think that's kind of the start of Chapter 9. The second thing that I would focus on is how to calculate depreciation. So we've got, the different depreciation methods. We've got straight line, units of activity, double declining. And I would definitely focus on how to calculate those. The third item, adjustments and improvements versus ordinary repairs. Just knowing when something increases the value of an existing asset and how that may affect the depreciation. I think there was an example on the slides from the professor on that. I wouldn't spend too much time on that, but definitely at least go over that material. And then finally, the disposal and sales of equipment or land, how to calculate the gains or loss on disposal. So those were some important concepts that we covered off on in Chapter 9. And, this chapter is a little bit meaty because you have, the cost of plant assets, all these different depreciation methods, and the calculations of gains and losses. So that one's a little bit, I think, a longer chapter than some of the others. And then we get to Chapter 10, which is the new material. And Chapter 10 goes through liabilities, and specifically, I think one of the biggest things that it goes through is the issuance of bonds, and when you issue something at a face, premium, or discount, and how to calculate that. Also, bond amortization, and one of the problems on the sample exam that I posted actually had an effective interest method problem on there. I think it's problem number 2. You don't need to know how to calculate that for the exam, so ignore that problem for that purpose because it's not going to be covered on the exam. What you do need to know as far as bond amortization is how to calculate bond amortization as it relates to the straight line method. So definitely make sure that you understand that for purposes of the exam. Again, don't worry about that number 2 on the sample exam. That was my mistake. I accidentally added that problem inadvertently, and that don't waste your time trying to figure out that problem because that problem's pretty complicated. So finally, I think redemption and retirement of bonds, gains and losses. I think also in this chapter is the sales tax, if I'm not mistaken. So I'm going to add that to Chapter 10. How to calculate the sales tax payable, or I think that's in Chapter 10. And there's also, if we remember, just like notes payable, we kind of cover off on notes payable when we go through adjusting inventory or adjusting entries. But how to calculate the interest on a note and how to make those journal entries, I would definitely know how to do. And yes, the PowerPoint will be posted after I'm done. Like I said, I'm going to add a couple things so that you have some tables to go through. So hopefully that'll help. So that's really it for Chapter 10. I mean, I think the bonds is going to be a big topic. I think that's a large portion of Chapter 10. And again, if I have time, I'll do a bond amortization question. I'll see if I can find one quickly. Then we get to Chapter 11, and again, this is another big chapter, and it goes through corporations and a lot of the accounting for the equity section of the balance sheet. And Chapter 11 talks about when we issue common stock and how do we record those entries. They're par value, stated value, no par value, and really these are just terms. So there's really no difference between par value and stated value, just different terminology, but the accounting is the same. So we're only going to record common stock up to the par value, and we are going to record anything additional into APIC or additional paid in capital. Same with the stated value. We're only going to record common stock up to the stated value and record the rest into additional paid in capital. Then we talked about the issuance of preferred stock. And here, the accounting, again, is very similar to common stock. Their preferred stock is going to have a par or a stated value, or it could be no par. You want to know what the accounting is for that. The other thing with preferred stock, and this is the third bullet point, is the dividends and accounting for dividends of preferred stockholders and common stockholders. And if you remember, preferred stockholders get preferences in terms of liquidation and in terms of dividends. So they're going to get paid their dividends first before any of the common stockholders. If the board declares a dividend, they're going to get paid first. Now, one thing we have to know is whether something is cumulative or non-cumulative in terms of the terms of the preferred stock. And if something is cumulative, let's say that the preferred stock was issued at the beginning of 2012, and the first dividend declared by the company was in 2014, if the preferred stock was cumulative, you would need to pay the preferred stockholders for every year that preferred stock was outstanding before you gave a portion to the common stockholders. If it was non-cumulative, you would just pay them for that current year that the dividend was declared. So in my example, 2014, the dividend was declared. If it was cumulative, you would have to pay them for 2012, 13, and 14. If it was non-cumulative, you would just have to pay the preferred stockholders for 2014. And what that means is then whatever's left over of that dividend that's declared then goes to the common stockholders. So I think that's probably one of the trickier concepts, and I think there's examples and practice problems on that too. And then finally, treasury stock. And treasury stock is when a company decides that they're going to buy back some of their shares, and maybe they want to, they don't want their shares to be so dilutive in the market, so they're going to buy some back. Maybe they've got extra cash, and you know, like I said, they don't want them to be diluted in the marketplace, so they're going to buy those shares back. And treasury stock is actually going to be a contra account in the equity section. So if I buy back shares of my own company, I don't record them as an asset, but what I do is I record them in my equity section, and they're going to have a normal balance of a debit because it's a contra equity account. So treasury stock is when I buy back my own shares, and I want to make sure that when I buy back my shares, I track the value of what I paid for them. And if I then turn around and sell them back out into the marketplace, I have to make sure that I'm doing my bookkeeping correctly. So I think I had done that in when I went through chapter 11 in one of the online sessions, but it's definitely important to kind of understand that concept of treasury stock. Now the difference between outstanding, issuing, and treasury stock is outstanding is the amount of shares that are actually in the marketplace that are available for buying and selling by anybody, by the public, if it's a publicly traded company. Issuing are the amount of shares that have been issued, meaning I could have issued more shares than I have outstanding because I could have potentially bought some back as treasury stock. When my shares are outstanding and I buy them back through treasury stock, they're no longer outstanding in the marketplace because now I'm holding on to them and they can't be freely traded out in the public marketplace. So the difference between outstanding and issuing is those that anybody can go out and buy in the public marketplace, and issuing is the total amount that I have available or have issued at some point in time. If they're the same, that means that there's no treasury stock. If they're different, the difference between the two should be what I bought back into treasury stock. So hopefully that helps. And then finally, Chapter 12 and Chapter 13. So Chapter 12, we talk about trading versus non-trading securities. So sometimes non-trading is called available for sale, but I think the professor will use the terminology in the book, which is non-trading. We also talked about, how to do the initial accounting for debt investments and stock investments, which include trading and non-trading securities, as well as understanding how to calculate changes in fair value. And unrealized gains and losses go in income for trading, and unrealized gains and losses go in equity for non-trading. And remember, fair value is the difference between the fair value is going to be what it's traded for today. So let's say that I buy Facebook today. So I initially buy Facebook at $50. At the end of the year, a share of Facebook goes up to $55. So then I would have an unrealized gain of $5 based on from when I initially purchased it to what the value is at the end of the year. And that unrealized gain that I have, because I'm still holding it, so I haven't realized it, don't realize it till I sell it, that unrealized gain, if it's a trading security, will run through the income statement in the non-operating section. If it's a non-trading security, it's going to go through the equity statement. And remember, the difference between trading and non-trading is that I record something as trading as if I am in the kind of if I regularly buy and sell securities, and I do that on a regular basis. I record something as non-trading is if I usually kind of buy a security or buy a stock investment and I hold on to it for a period of time. So that's the difference between when you classify something as trading or non-trading. And I think on the exam I wouldn't worry so much. They're going to tell you if the stock investment's trading or non-trading, so you won't have to figure out whether it is. That was more just kind of a side, but I would definitely make sure that you know that any of the unrealized gains and losses for trading securities go through the income statement, and any unrealized gains and losses for non-trading go through the equity portion of the balance sheet. So definitely make sure you know the difference there. The next thing then is cost method and equity method and consolidation. So cost method is how I record investments where I hold less than 20%. So I'm going to record them at the cost when I initially purchase them, and then I'm going to make any fair value adjustments on those debt or stock investments. So if I only own 2% of Facebook shares, let's say, I'm going to account for it using the cost method. Now, the equity method is when I own when I own anywhere from 20 to 50% of a security. If I own more than 20% but less than 50, I use the equity method, and the reason I do that is I have influence over the company because I own more than 20%, and the accounting for that's going to be a little bit different because what you're going to do is you're going to record any dividends as a reduction of your investment, and you're going to get the benefit of recording your proportion of the net income of that company as what's called an equity pickup or revenues from stock investments in your income statement. So if I buy Facebook and I own 20% and they make $1 million, which I know they make way more money than that, I'm sure, and like I said, I own 20%, I get to record the revenue of $200,000, my portion of that $1 million, in my income statement because I own such a significant portion of that investment. And then consolidation is when I own more than 51% or more, basically. And then you consolidate. So you take all the assets and liabilities of the company, you take all their revenues and expenses as your own, and you record that as part of your financial results, and you have what's called a minority interest. The only thing you'll have to know for consolidation is you'll need to just know that if you own more than 51% that you have to consolidate an investment. For cost method, if I have a dividend, one of the differences between the cost method and equity method in terms of dividends, if I get paid a dividend under the cost method, that actually becomes revenue to me. Remember, under the equity method, if a company pays a dividend, that actually just becomes a reduction of the initial investment. So there's a difference between the two. So for equity method, if you have a dividend, it doesn't get included in as dividend revenue. Again, it just gets accounted for as a reduction of your initial stock investment that you made. Normally, you don't have a trading security that is greater than 20%, because if it was greater than 20%, you would account for it under the equity method. So you normally won't have that. So when we talk about trading and non-trading, it's usually going to be for investments that are, less than 20%, or, originally accounted for under the cost method. And there are some nuances to that, but that's very complicated, and you won't have to know that for this class. So I would just use as a general rule of thumb right now. Let me see what else. You don't need to know, like I said, under consolidation, any of the journal entries for consolidation. The only thing you need to know for consolidation for purposes of the exam is that any investment greater than 50%, so 51% or greater, would need to be consolidated into your own financial results, and that's all you need to know. If you continue on with accounting, you will need to know how to do consolidation and I think it'll be covered in more detail in one of the more advanced classes. But you need to, at least for this class, especially if you're going to go on to be an accountant, understand just the concept of what consolidation is. So that's it. No journal entries, no knowing how to consolidate. I wouldn't worry yourself with that, just the concept. And I think those are the key things from Chapter 12 that you should focus on. And then finally, we have Chapter 13. And Chapter 13 is cash flows. And this is one of the hardest concepts, I think, that you have to know. And everybody has to know it, I think, for purposes of no matter what your business major is. You need to know how a cash flow is put together, how to read it, what it means. Be it if you're finance, marketing, management, you all need to understand what the impacts of your business is, or the portion of your business is, on the cash flow. And there's two different methods. There's the indirect method and the direct method. What I would say is I would focus on the indirect method because I think that's what majority of the companies do. And all I would know about the direct method is just the difference. I mean, I wouldn't spend a lot of time on that. I would again focus on the indirect method. And the test, again, last year, the test, you actually had to write out the entire cash flow statement. This semester, the professor has made the questions that relate to the cash flow multiple choice. However, in order for you to answer those questions, you're going to need to be able to prepare a cash flow statement. Otherwise, you're not going to be able to answer the multiple choice questions, or you won't be able to answer them without doing that. So I would practice with the homework problems, practice with, I think I added a cash flow statement on the sample exam, and just make sure that you can kind of write out and, write down the cash flow statement, even though you're not going to have to handwrite it on the exam, because you're going to need to know how to do that for purposes of the multiple choice questions. And there's 17 questions on a cash flow statement. So definitely make sure you know how to do that. And I think that is generally the topics that I would focus on if I were you. So hopefully that was helpful. I want to go through the cash flow on the sample exam just so that everyone can kind of see it. I think, in my opinion, that's a pretty big chunk of the exam. So I want to make sure that, any of maybe how I talk about it versus how the professor talks about it, maybe it'll click a little bit easier for you. Maybe it won't. Maybe I'll explain it a little bit differently and you won't like how I explain it, but at least you'll have some other kind of, example to go through. I think right now you're going to have to do it from scratch. I don't think that he'll give you a skeleton to fill out. I mean, at most the skeleton will say, the skeleton will look like this. We'll just say cash flows from operating, cash flows from investing, cash flows from financing. I don't think it'll have anything else in there. So you're going to have to know where the pieces go. So with that being said, let's do this problem now, and then if I have time, I'll go back through a couple of the examples that some folks had asked me on, and try and find an example of those problems. I'll ask him. Somebody's saying he said you will do that. I'm assuming the skeleton again will look like this. I don't know what the skeleton is that he gave in class, but I don't think he's going to put in there whether or not something's an increase or a decrease in accounts receivable. It might say like something like this. And that's all it'll say. I mean, it's not going to tell you if it's an increase or decrease. You're going to need to figure that out yourself. So, I mean, that's my understanding. And if I'm wrong, I'll post a message about that. But I would definitely make sure you understand how to prepare the cash flow statement in terms of determining whether something's an increase or a decrease and such, because you're not going to be able to solve the multiple choice questions unless you understand those concepts. So with that being said, let's go through this problem. And I've kind of added a couple of roll forwards that I think will be helpful for you in terms of solving the cash flow. And we'll go through each of those. So first things first is you're going to be given certain information. The first thing you're going to be given is a balance sheet. You could be given an income statement, and then you're going to be given some additional information. This problem just gives a balance sheet and some additional information. But if you're given an income statement, you can figure out what the net income is based on the income statement, which we know with the indirect method we need to start with. You can also figure out, there could be other information on there like depreciation expense, amortization expense, or gains or losses on disposal. So, definitely look at that income statement so that you can figure out, what some of those non-cash income statement items may be. Let's see. So here, what I would do to start out with is I would take the comparative balance sheet, and I would literally compare the current year balance, which is 2013 to 2012, and I would go down and do that for every single item on the balance sheet. Because these changes, I don't have an example using an income statement, but again, it'll be just a small piece of information, so I wouldn't concern yourself. It'll have, so for example here, number 1 says net loss of 2013. If it's the exam, you might have an income statement that shows the net loss is $20,000 as opposed to being given it under additional information. So it's really no different if it's listed under additional information or if it's in a table such as an income statement. So let me go through that, and I'll go through any questions at the end, just so that I can make sure I get through the problem here. So the first thing I would do is I would go through and calculate the difference between all the balance sheet items, because we're going to go one by one down each of these changes and figure out how it impacts the cash flow statement. And our goal of the cash flow statement is to, and again, if you can please keep your phone on, or your computer on mute. There's just background noise, and it's hard to talk with the background noise. The main goal of the cash flow statement is to figure out what are the activities that relate to the changes in cash. So the cash here has increased by $5,000 from 2012 to 2013. And we want to figure out what are cash flows from our operating activities that contributed to that increase. We want to figure out what are the cash flows from investing activities that have contributed, and likely the same thing for financing activities. So that's our main goal. Our main goal is to make sure the sum of all those activities get us to a net increase in cash of $5,000. So down here, this should equal $5,000 at the end when I sum up all those activities. That's our goal. That's the main objective of the cash flow statement. So it's very important that you understand that's what you're trying to get. You're trying to get all these activities, the sum of all of them, to equal that $5,000 change, because we had an increase in cash of $5,000. So then what we're going to do, what I would do is I would then go down each of these items and I would say, what section do they impact? So accounts receivable impacts operating, prepaid insurance impacts operating, land is a long-term asset, it's going to impact investing, same with equipment, and then accumulated depreciation is going to be operating and investing. Accounts payable is going to be operating, bonds payable is going to be financing, common stock financing, and then retained earnings is going to be operating and financing. And the reason why I say operating as well as financing is because what impacts retained earnings are going to be net income and dividends, and net income is going to be in operating, and payments of dividends are going to go in financing. So now we know kind of what the pieces are, or where the pieces go, and we're going to go one by one and start figuring out what the different activities are. And we're going to start with cash flows from operating activities. And remember, under the indirect method, we're always going to start with net income. And net income here is actually a net loss. So let's make that a net loss. And it's going to be a negative amount of $20,000. And we know this based on this additional information here. And remember, if you're given an income statement, just pull the net loss number off of the income statement. And then we're going to do adjustments to reconcile cash, to reconcile net income to or here it's going to be net loss, to net cash provided by operating activities. I'm just going to abbreviate for sake of time. And we're going to add any depreciation, amortization, or depletion, or gains or losses from sales or disposals. So we don't have any amortization, just given the nature of the items. We don't have that in this problem, but if we did have it, we would need to include that. We know we have depreciation because we've got equipment, and remember, equipment depreciates. So we're going to need to figure out depreciation expense. And land doesn't depreciate, so you're not going to have to worry about depreciation for land. So the only thing we have to worry about for depreciation is equipment. And we're going to add depreciation expense to reconcile our net loss to net cash provided by operating activities. And the reason why we're going to add depreciation expense is, remember that our income state or our net loss is on an accrual basis. And the whole point is to get from when we recorded our income statement on an accrual basis to get it to cash. So we want to pull out all those non-cash items to kind of get us back to a cash basis. So everything we've learned where we talked about getting things on an accrual basis, we're kind of undoing in the statement of cash flows to figure out what our true increase, decrease in cash is going to be. So if you think about it, on the income statement, depreciation expense reduces my net income, or contributes to the net loss. So to take it out, we need to add it back. And the same thing for amortization, and the same thing for a gain on disposal. If I had a loss on disposal, I would want to subtract it, do the opposite. And if inventory was listed, you would just have it as another item on the balance sheet, and it would be related to operating activities. So you would just do the compared, similar to how you had done accounts receivable and prepaid insurance. So now we want to figure out what our depreciation expense is. And if I look down this list of additional information, it's not listed here. So we need to figure it out. And how we're going to do that is we're going to roll forward property, plant, and equipment. And you can roll forward any balance sheet account, but I would definitely know how to do property, plant, and equipment, and also know how to do retained earnings, which we'll go through. And what we're going to do is, there's two ways you could do it. You could do it by looking at the pieces. You could look at it by looking at equipment on its own, or accumulated depreciation on its own, or you can do it net. And the professor has done it on a net basis as well. It could be that on the balance sheet, some companies will present this net anyway, so you won't see these two pieces. So what you can do is you can just kind of make it net yourself, and this way you'll follow the professor's way. And if on the exam it says net, you'll know how to figure out the roll forward, because you're going to need to know how to do this roll forward to figure out all these pieces that are going to impact the cash flow. So what we're going to do is we're going to start with the beginning balance net, which is going to be our cost of our equipment less the accumulated depreciation. So our net balance at the beginning of the year is $47,000, just the sum of these two. And our ending balance is going to be the net of the equipment and the accumulated depreciation, or $50,000. So that's what we want to get to. Then we need to figure out if we've had purchases, sales, what the depreciation is, and then if there's any gains or losses on the sales that we have. So here, right away, I can tell that our equipment has gone up on a net basis by at least $10,000, and our accumulated depreciation has also increased by $7,000. But let's go back down to this additional information and see if there's anything else that's listed. And number 4 tells us that we also sold equipment. So we had equipment that had a cost of $15,000, accumulated depreciation of 10, and we sold that for $5,000 cash. So we must have had a purchase and we must have had a sale here, because we can see that equipment has gone up, but we also note in this additional information that we sold some. So there has to be a purchase and a sale at the same time. So let's start with a sale, because we're given a lot of information about the sale, and we're not given any information. We're given a little bit of information about the purchase. So for the sale, we can see here that the equipment had a cost of $15,000. It had accumulated depreciation of 10. So on the day of the sale, the net book value was $5,000, and we also sold it for $5,000. So in this example, because what the net book value was and what we sold it for, they're the same, we're not going to have a gain or loss. We're just going to have sales of $5,000. And our gain or loss is going to be 0, because the net book value and what we're selling it for are the same. Now let's say we sold it for $10,000 instead of $5,000, then we would have a gain. Or if we sold it for $2,000 instead of the net book value of 5, we would have a loss. So definitely make sure you understand how to calculate whether or not you have a gain or loss if you're given information like this. So we know these are 0. And then if we go to 5, it says that we have equipment that was acquired for common stock, and the fair value at the time of the exchange of that common stock was $25,000. So we have additional equipment of $25,000. And that's going to be as part of our increase here in equipment. So if you think about it, that kind of makes sense, because $15,000, this change decreased by $15,000 and goes up by 25, so the net change is going to be $10,000. The last thing then we have to do is figure out depreciation. Now here we know the ending balance, so we can just plug it in if we want. If you follow kind of all those concepts, so you can take this plus this. This gives us our ending balance, so then we can just solve for depreciation, and then we would get negative $17,000. Or you could do it another way. You could say that this change in accumulated depreciation, if there was no sales or anything, this change in and of itself would be our depreciation expense. But we had a sale where we removed $10,000 of the depreciation, so we have to take this change plus the $10,000, and that's going to be our total depreciation expense for the period. And that's how we're going to figure out what our depreciation expense is. And what we're going to do is we're going to, remember, we're going to add depreciation, so we're going to add that $17,000 back to our adjustments to reconcile net income to net cash. And the $25,000 here is just because we exchanged our own common stock for equipment. And the value of that common stock at the time that we exchanged our common stock for equipment was $25,000. So our assets are going to go up by $25,000, and our common stock is also going to go up by $25,000. And this is actually going to be a non-cash item for investing and financing. And that's going to be a supplemental disclosure. So it's not going to go as part of our cash flow because no cash changed hands in number 6 here. But it's going to impact how our equipment balance has changed from last year to this year. So we need to include that $25,000 in our roll forward. That's actually a really complicated part of this problem, is knowing that that $25,000 gets captured as part of the roll forward, but doesn't get captured as part of the cash flow statement as an investing activity because there's no cash that's changing hands, right? Because here we're giving our own common stock in exchange for equipment. No cash is changing hands, and that means we just have to disclose it at the bottom of the cash flow statement. All right. Now, if for some reason I had purchased this equipment for cash, then I would list it under investing. Okay, because if I paid cash for it, it's going to impact my cash flow statement. And there's 2 ways in this problem that I got the value of depreciation, just to kind of go through it again. 1, I just plugged it in. I know my beginning balance. I know my purchase amount based on number 6. I know my sales amount based on number 5, or based on number 4, I'm sorry. I know I don't have a gain or loss because my sales, the net book value, and the cash proceeds that I got are equal, so my gain or loss is going to be 0, and I can plug and get the 17,000. Or here I can look and see that I had accumulated depreciation of negative 13,000. And I'll write this down. So let's say I have accumulated depreciation, beginning balance, and it was 13,000. And I know that I am selling equipment that had accumulated depreciation of 10,000, so I'm going to remove it. So here I would remove 10,000. To remove it, remember, I'm going to debit it or add it, right? So this is add for sales. And then I'm going to subtract or credit. Let me actually say subtract here. We're talking in debits and credits here, so it's a little confusing with let's say this is a credit balance, and subtracting it means I'm debiting the accumulated depreciation account. And then I'm going to add depreciation, which here is going to be our X value, right? We don't know what that is. And then I've got accumulated depreciation ending balance, which we know that's 20. So here you can just solve for X, and that'll give you the 17. So that's kind of how I would figure out. This has to be a negative 17 or a depreciation expense of 17 in order for the sum of all these to get to be the ending negative 20,000. So hopefully that helps too. You could roll forward each of these pieces on its own, or you can do it this way. And the beginning balance of 47,000 that I have here is just the sum of the equipment and the accumulated depreciation. Because here in my first roll forward, I've done PP&E net as my beginning balance. So I'm just taking the cost and the related accumulated depreciation and starting off with that as a total. So if I did it the second way that I showed for accumulated depreciation, what I would do so this way here just rolls forward this account here, right? It just rolls forward this one line item separately. If I were to roll forward this line item, then, because I would need to do both of, if I'm going to do this separately, I then need to do this on its own. What I would do is, let me see if I would take my PP&E, or equipment, I guess, balance, beginning balance, which is 60, right? It says it right here. I would add purchases, subtract sales, and I would take my equipment. I guess here I would have to factor in any gains or losses, which are 0 here. And then I would get my equipment ending balance. And here, if I know my sales are 5,000 and my ending balance is, I've got no gains or losses, right? And my ending balance is 70. Here, actually, this is going to be a negative 15 because I'm taking off the cost basis here. Here I'm dealing with the cost basis. Then this would have to be 25 in order for this to work. And that gives me 70. Okay, so here, what I'm trying to do is, on this net one, this sales number is going to be my net proceeds. So it's going to be the actual cash that I get when I'm figuring out this roll forward. But here, if I use each of these line items separately, I need to use the cost basis as part of my sales. So there's a difference, and I think the professor went through it this way in class. And, again, I would probably try and, make sure you understand how to do it this way as well, in case it's presented net on the cash flow statement. So that's just my opinion. So hopefully that helps a little bit. This is one of the most complicated portions of the cash flow statement, is figuring out the things that relate to PP&E. So make sure you understand these roll forwards. And I can post this file just so you can see how I'm calculating the different numbers on here, with the slides. I'll have a separate folder that is called review session, and I'll post this file as well. So that's going to be depreciation expense. We've got one line item here. We don't have any gains or losses on the sale of equipment, but we've got, it looks like a sale of land. So we have to see whether or not we have a gain or loss on the sale of land. Number 3 here tells us that land was sold for a loss of $4,000. So we want to have a loss on disposal of land. And that's going to, because it's a loss, we're going to add that back for $4,000. So here we've covered off on 3, 4, and 6. And I think that's it in terms of the non-cash items that impact the income statement. So now we can go right to the changes in the other items like accounts receivable. So accounts receivable went up. So if we have an increase in accounts receivable, we're going to subtract it. If we have, the next one we have an increase in prepaids, we're going to subtract it because remember you're going to do the opposite for assets and we're going to follow and go the same way for liabilities. And then the last operating activity that we have here, because we covered off on the depreciation already, is accounts payable. And it looks like they've increased as well. So we're going to increase in accounts payable. And that's going to be for $5,000. And that's all of our operating activities. So we've covered this, 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 and this. And now we can sum up what the value is of our operating activities. So we're going to sum up, and we're going to include the net income or net loss in the sum total. And we have a net cash outflow of $12,000 as it relates to operating activities. So that's the operating section of the cash flow statement. Then we're going to go to investing. And investing is going to be things like investments that we may make in debt or stock investments. It could be if we purchase land or if we purchase additional equipment. If we sell land, sell equipment, we're going to include that in investing activities. So we know that we sold land and that we sold equipment. So what's going to go here is we're going to put our proceeds from the sale of land, and that's going to be the cash that we actually got on the sale of land. And just to answer someone's question, do we need to include retained earnings? We need to include the net income as part of operating, which we've done already. And then the dividends portion is going to go in financing. So half of it's going to go in operating, and the other half's going to go in financing. So here we've already got the net income in there. So for the proceeds from the sale of land, we know that we sold land at a loss of $4,000. And we can see here that land has decreased by $22,000. So in order to figure out what the proceeds were from the sale, this $22,000 represents the book value of the land that was removed from on the balance sheet. And if we had a loss of $4,000, that's going to mean that our proceeds from the sale are going to be $18,000. So we got cash of $18,000 when we sold the land. It had a value on our books of $22,000 because you can see that change right here. But we had a loss of $4,000, so we must have got cash of $18,000. So that's going to be the proceeds from the sale of land. So again, our beginning balance of land is $40,000. We can see that that the value of the land went down by $22,000. So that must be the book value. Let me do it this way. So the book value of land sold is $22,000. We had a loss on the sale of $4,000. So the proceeds that we must have received are going to be $22,000 less $4,000 or $18,000, because if it had a book value of $22,000 and we had a loss on it, we must have got less cash than the book value. So that's how we get the $18,000. And then we're going to do the same thing for equipment. and for the equipment, they actually tell us what the cash is or the proceeds are. So here we've got proceeds from the sale of equipment. And that is $5,000. And remember, because we're selling it, they're positive because we're getting cash in return, so it's a cash inflow. And then the book value is an $18,000 stated in 2013. This it just happens to be a coincidence. This $18,000 is what's the piece of land that's left that we have. So maybe we own 2 pieces of land. We sold one of them that had a book value of 22. This 18 is for another plot of land that we have. That's the book value of that plot of land. I'm not really sure the question, aside from this 18 that left is just coincidental. That's the same as the proceeds. Okay, so that's our proceeds from sale of land and proceeds from sale of equipment. Those are our 2 investing activities. I don't see anything else. And let's go down here. We've already got the net loss. Dividends are going to be financing, and bonds are going to be financing. So that's all of our investing activities. Let me just move this up. So this is going to be net cash used in operating. Net cash provided by investing. It's going to be the sum of these 2. This plus this. So we had $23,000 of net cash provided by investing. So now we'll go to financing. We've got all these covered off on. We've got this covered off on. So now we've got bonds. And we can see that bonds have increased by $8,000. So I would think that we must have had an issuance of bonds if bonds have gone up. So bonds have gone up by $8,000. And we can also see that bonds were also retired for $22,000. So we've got 2 things that are happening. And those 2 things that are happening is that we must, because there's an increase on the overall bonds payable, we must have had an issuance of bonds, but we also know that we have a retirement. So we've got a retirement of bonds that we need to capture. So let's do the retirement first. We're going to do retirement of bonds, and I'll answer your questions on the investing section in one second. Retirement of bonds payable. And here it says that bonds were retired at their carrying value, so there's no gain or loss. And here we're going to put, when we retire bonds, it's going to be a cash outflow. So we're going to have negative $22,000 because when we're retiring bonds, we're giving the bondholders back their cash in exchange for taking the bond back. So it's going to be a negative cash outflow. But if we look at that change for the retirement of bonds, if that's the only thing that impacted bonds payable, this number here would be negative 22. But I've got a positive 8, so I also must have an issuance of bonds payable. And that has to be for $30,000, okay? And the reason it has to be $30,000 is because if my net change in bonds is $8,000, and I know that I had a retirement of bonds of $22,000, I must have also had an issuance of bonds of $30,000, so the net of $8,000 gives me an increase to bonds payable. So I have to somehow infer, based on this information, that it couldn't have just been the retirement of bonds. There had to have been something else that happened because the net change in bonds payable is an overall increase, and that overall increase is going to be for $8,000. So that's how we handle the bond payable account. And then the next thing we have to do is capture issuance of common stock. So here, common stock went up by $25,000, right? But if you recall, that $25,000 was for the exchange that we had for common stock for equipment. So we didn't get cash when we issued that common stock. We got equipment in exchange, and we've already captured that as a non-cash item. So we're going to put purchase of equipment for common stock. So there's no need to put issuance of common stock here. Now, if we didn't have that exchange and we saw an increase in common stock, we would make the assumption that it was for cash, and we would include the issuance of common stock here as a separate item under financing. And then the last thing then we have left is dividends. And here you're told that the dividends that are declared and paid are $14,000. And if those dividends are $14,000, then and they're giving you that information, you can put payment of dividends for $14,000. But you might not be given that information of the, and I'll answer all your questions at the end because I think there's a bunch of questions now, and I just want to finish up. If you're not given this directly, if you're not told what the dividends are, you can find it out based on the roll forward of retained earnings. So here, remember, retained earnings is going to be our beginning balance of 55. And then we're going to add or subtract net income or net loss, depending on what it is. And we know that we have a net loss of 20,000, so we're going to subtract 20,000. And we know what our ending balance of retained earnings is. It's 21,000. So our dividends, in order for us to get from 55 to 21,000, must be 14,000. So you can just solve for x. And this should roll forward to 21,000. So here, if you're not given this information, if you use this little roll forward here, you can actually figure out what the dividends are, because you'll know what net income is or net loss. And if it's net income, you're going to add net income, right? Here we're subtracting it because we have a net loss. And then you can solve for x. So that's how we could find out the 14,000 if we're not given it. Then we're going to sum up our net cash used in financing. And again, I'm just abbreviating here. Let's move these over here. And we're going to sum these up. This plus this plus this. And we have a negative 6,000 as a cash outflow. And what we want to do is we want to add now the three activities. So our negative 12,000, our 23,000, our negative 6,000, and we want it to be equal to this change in cash. So we're going to take the sum of these three items, and it equals $5,000, which is the net change in cash, or net increase in cash. And we found that net change by taking our beginning period, and we compared it to our ending period, and we see that it's 5,000, and all three of these activities, if we take the sum of them, equal the net change of 5,000. So that's how we would solve this cash flow. Now let me go back and answer the questions that we had. Let's see here. Okay, so the first question that I didn't answer was, what about the additional purchases? And I'm assuming you mean the purchases of $25,000 on the equipment account. Remember, we don't need to include the purchases for this $25,000 because, remember, in order to purchase that equipment, we actually gave common stock instead. We didn't pay cash. So it's a non-cash transaction. It doesn't belong in the investing section. It belongs as part of the non-cash items for investing and financing, because in exchange for equipment, we actually gave common stock instead of cash. So that's why purchases isn't included in investing. If we did not exchange common stock and we paid cash for it, we would absolutely include that $25,000 here. So that's that question. Hopefully that answers that. The next question is, if the book value for land is $22,000, why isn't the number a negative for proceeds of land? The reason why it's not negative is because when we're talking about the cash flow statement, sales are positive, right? Because sales result in a cash inflow. If we're selling the land is no longer on our books, right? So that decreases, but we're getting cash in return, and that becomes a proceed or a cash inflow. So we're getting $18,000 for that land. So even though that this has gone down by $22,000, and 4 of that relates to the loss, the $18,000 that's left are the proceeds that we're getting, and proceeds are an inflow. Cash is coming to us. So that's why it's positive there. The next question is, why do you have the loss on disposal of land included in operating activities, but then also account for the loss and the proceeds of land under investing? Well, I'm capturing the change in the land account by using the loss on disposal and the proceeds together. So I need, in order to figure out what the proceeds were in this problem specifically, because it's not given to me, I need to take the book value of the land, compare it to the loss that they're telling me, and that's going to tell me my proceeds. Normally what happens in these problems is you're given the book value of what you sold, and you're given the proceeds that you get, and from there you can determine what the loss is. So that's the reason why we're using that $4,000. It just happens the way this problem is set up that we need that $4,000 to figure out what the $18,000 proceeds were. The change here is 22. We know, though, that 22 represents the book value coming off our balance sheet, but we didn't get 22,000 for the land. We had a loss of 4,000, so we must have got 18,000 as the proceeds. And remember, we want to adjust the net loss here for the non-cash items like loss on disposal. That goes in operating. It's just where it goes for purposes of reconciling net income. So that's that question. The next one is, how do you find $30,000 for the issuance of bonds payable again? So let's look at bonds payable, and we can see that bonds payable, we had 19,000. Let me see here. Let me write another roll forward. So our beginning balance of bonds payable is 19,000. We're going to subtract for the retirement, and we're going to add for the issuance, and that's going to give us our ending balance of bonds payable. We know that we had 22,000 of bonds retired, and they were retired at their book value, so there was no gain or loss that we have to figure out. If there were gain and loss, we would need to include that in our roll forward here. And we know what our ending balance is. Our ending balance here is 27. So if I just take those three things and I sum them up, if I take 19 less 22, that doesn't equal $27,000, right? It equals $3,000. So something else must have had happened, because we know that our net change here is $8,000. So we can just solve for X, which is going to be $30,000. And now my roll forward will work. The sum of my beginning balance less what's retired must have meant that I had also an additional issuance of bonds of $30,000, and that's going to give me the $27,000 ending balance. So these two together sum to $8,000 and represent this $8,000 change. So that's how I figured out the $30,000. So hopefully that helps. I think that's the next question as well. And then someone's asking to calculate the free cash flow, so I will do that next. So free cash flow will come next. Give me 1 second. Let me keep writing. This one I might have to get back to you on the free cash flow, because no, I can do it. Okay. All right, I'll do free cash flow in 1 second. Let me just read through the rest of the questions. And I think I answered your question, Deep Thacker, on why the investing is not included under the investing section already, because it's a non-cash transaction. I know it doesn't apply to this problem, but will we ever need to add, subtract unrealized gain and loss in the operating activities? Yes, you would. But I wouldn't worry too much about that. But you absolutely would have to, Rudra, it's a great question, have to include, if there was an income statement item for unrealized gain loss, related to trading securities on your income statement, because that's also a non-cash item, you would absolutely put that as part of the operating activities. So that's that. And does the extra non-cash item affect any of the totals? No, it just becomes additional disclosure at the bottom of your cash flow statement. So it doesn't affect any of the totals as part of the increase decrease in cash, or as part of any of the separate activity totals. So no, it does not. It just becomes extra disclosure that if someone were to pick up your financial statements and they were to be going and looking at the changes in your equipment account, and they see the 10,000 and only see sales of equipment of 5, then this would tell them that there was also an increase in the purchase of equipment. So that's why you need to add that as additional disclosure. And someone's still confused about the bonds payable. Take a look at this roll forward here, because this is kind of helping you figure out how we're getting to the net change of 8,000. So here, if I take the retirement plus the issuance, that gives me my change of 8,000. The information I'm given is I'm given the 19, I'm given the retirement of 22, and I'm given the 27. If I just take those 3 items, I don't get a change or an increase of $8,000, right? I would have a decrease of 22. Something else must have happened, so I have to figure out, okay, well then I must have had an issuance for 30,000. So that's how I kind of have to figure that out or infer that based on what the change is. I'm not 100% sure how to explain it any other way, but hopefully, if you can kind of keep looking at this roll forward here, and again, I'll post this file, it'll help you. So I think that's all the questions on Chapter 13. We're not going to go through a worksheet here, but yes, there will be a worksheet on the exam, and I think there will be 5 questions on the worksheet. So definitely use the sample exam from midterm 1 to practice with the worksheet. But yes, there will be a worksheet on the exam. And then retained earnings. So remember from the beginning chapters, if we did like a retained earnings roll forward, we're going to take our beginning balance of retained earnings, which is the 55,000. And in order to roll forward the account to get to our ending balance, we're going to add net income or subtract net loss, depending on whether or not we have net income or net loss. And then we're going to subtract any dividends. So here we know from the problem that we have a net loss of 20,000 because they tell us that. And if we were given the income statement would show the net loss. So we're going to subtract that. We also know from the problem that we have dividends of 14,000, and when we pay a dividend, it's going to reduce our retained earnings. So we're going to subtract dividends. And if we roll forward this amount, it's going to give us our ending balance of 21,000. So we know that retained earnings works because if we take our beginning balance, adjust for the changes that happened, we get our ending balance. On the exam, you might not be given the dividend number, let's say. And we can figure that out with the other information. We know the beginning balance, we know the net loss, we know the ending balance. So in order for us to get this to work or to roll, we need to figure out what the dividends were. Because if I just took the sum of the 55 and the 20, that gives me 35, but I know my ending balance is 21. So I must have had a payment of dividends of 14,000. Definitely make sure you understand this because you might not be given this on the exam. You might not. So I'm just trying to help you out and give you an extra kind of explanation of how you would figure out dividends. So hopefully that helps. It's just taking that kind of retained earnings roll forward or changes in retained earnings and figuring out what the dividends piece is. Let's see. So let me do the free cash flow real quick. Hold on. I'm just trying to, let me do free cash flows real quick and then I'll answer the rest of the questions. So free cash flows. Free cash flows, you're going to take the cash flows from operating. You're going to subtract any capital expenditures. And capital expenditures are when I have purchases of things like equipment or land. And then you're going to subtract dividends. I think that's the formula, right, for free cash flows. So in this problem, we're going to take our cash flows from operating, which was -12. We're going to subtract capital expenditures, and here we're going to subtract capital expenditures where we paid cash. Remember, when we purchased equipment, we didn't pay cash for it. So our capital expenditures here are going to be 0. And then we are going to have subtract dividends, which I think are 14. So here our free cash flow is going to be this is going to be it's going to be 12,000 less the capital expenditures less the dividends. Don't put the negative here. Take that negative out there. So you're just going to subtract the total of dividends. So your free cash flow is going to be a negative $26,000 here. This capital expenditure number, like I said, it's going to be whatever is under investing for purchases of things like equipment or land. So those are things that are called capital expenditures. So here we don't have any of those, so that it becomes zero. If let's say we had, let's say this was a purchase of equipment where we actually paid cash for it, then we would just put the 25,000 here, and our free cash flow would become negative 51,000. So here, that becomes it's zero. So that's how we calculate free cash flows. There'll be 17 questions on the cash flow statement and 67 questions overall, which I think people have answered. For the retirement of bonds, would we ever have to use the par value, or would they ever include that? It would depend on the par value. I think you mean face value as opposed to par value. But I think you would just focus on the change in the bonds payable. Don't worry about that so much for the retirement of bonds. I wouldn't go crazy over that. I already explained what's under capital expenditures for free cash flows. 17 questions. Thanks. Can you re-explain the depreciation expense calculation? Okay, so there was two ways that I did it. Here, let me go through and do it. Here I just plugged it in because I knew all these other pieces on the roll forward. So I knew my net beginning balance. I knew what my purchases were based on number 6 here. I knew what my sales were based on number 4 here. I knew I didn't have any gains or losses on the sale based on number 4. So I just plugged in the 17,000. You could be given that number as part of the additional information, so you wouldn't have to calculate it. In this problem, you have to calculate it. The other way you can do it is if you don't want to net the PP&E number on the balance sheet. Again, companies could show this number net, so you might not be able to break it out separately like this piece down here. So definitely make sure you understand this roll forward right here. But if you wanted to do it just based on the accumulated depreciation account, you can start off with the beginning balance. We're going to subtract the accumulated depreciation that we're removing upon the sale of the equipment, which is from number 4, or $10,000. And we know our ending balance is $20,000. So we can then find what the depreciation expense is. And this is just, again, this number here I'm plugging because I know this number, I know this number, and I know this number, so this becomes a plug. And this here also becomes a plug because I know this number, this number, this number, this, and this. So here I'm just plugging in and solving for depreciation. So hopefully that helps as it relates to depreciation. I still don't understand how 22 is the book value of the land, because if you think about the journal entries for when you have a sale of land, right, or a sale of anything, what you're going to do is you're going to take off the cost basis of that asset, and that gets reflected here in the change in the land account, right? Because when I sell the land, if I know that I'm going to have a loss on disposal of 4, and my land is coming off the balance sheet, and I know it's coming off because I can see that it's being reduced, the cost of my land has to be the amount that it's reduced by, or $22,000. So I must have got cash of $18,000 for the land. It's the only way for your journal entries to work, because remember, when you reduce your land account, when you have a sale, you're reducing it for the cost basis. So that credit to land, or that reduction in land that's shown here, is what the credit amount is, or it's the $22,000. That has to be the only way that anything is going to work based on the information that's given to you. For this journal entry to have been recorded, and for us to have had a loss, and for this to have been a negative 22, this has to be the book value. And the reason that it is because when you make this journal entry, you're crediting it for the cost basis, and the cost basis of land is the same as the book value because we don't have accumulated depreciation as it relates to land. So that's why that has to be 22. So hopefully that helps, Bhumi. So retained earnings is only used to calculate dividends. In this case, yes, it is only used to calculate dividends because we know what net income and net loss are. I mean, I would think that in any example you're going to be given the net income or net loss because you're going to have the income statement. So that's why we're using that retained earnings roll forward. Capital expenditures is 0 because we didn't pay any cash for, we don't have any purchases of land or equipment here. Those would be things that would be capital expenditures. So things that you capitalize on your balance sheet. Those are going to be examples of that. Is there a way to check the value you get from the free cash flows? No, you just have to memorize the formula. How did you get beginning and ending balance for PP&E net again? So again, I just took the equipment value less the accumulated depreciation, and that gives me PP&E net, or $50,000 as the ending balance. $47,000 is the beginning balance. I take equipment, which is, again, this line item here represents the cost basis, and this line item, accumulated depreciation, represents the accumulated depreciation on the account. So the beginning balance PP&E net, this $47,000 is the book value of the equipment at the beginning of the year. This $50,000 is the book value of the equipment at the end of the year. So that's how I got the beginning and ending balance. And I think I put formulas in there, so when I post this, you can see as well. Can you briefly list all the things that we will potentially have to do the roll forward for? I've gone over what I think are the things you should definitely make sure you focus on. I can't tell you how to do all of them, but these are the ones that I highlighted are the PP&E ones, the retained earnings one. You should be able to roll any balance sheet account that you may have. The bonds payable one, again, you should be able to roll any account. This one is kind of unique to this problem, but if you're given that, you all would know how to do that at this point. So any balance sheet account, you should be able to do a roll forward based on the activity that happens. But most of the time, because a lot of these accounts aren't going to have some nuances that impact the cash flow in different ways like PP&E does or like retained earnings do, you can just take the changes on the balance sheet. So that's why I focus on those two. Based on the roll forward, that should be 50. Oh, I must have a number wrong. Sorry, hold on one second. 1 second. I think I have something plugged in wrong. Something must be tagged inappropriately there. Let me see here. Let me figure that out. I'll adjust that on the file I resend. There's something wrong with my formulas, I think. Let me go back and check that, but I'll repost that and I'll send a note to everyone. So thank you for pointing that out. I think I have something wrong with my formulas there and my PP&E roll. Let me figure that out real quick. You know how you said we need to be on the lookout for amortization expense and depletion expense if given on the net income statement instead of additional? Is there any other information that we need to include? I'm not sure what you mean by any other information that we need to include. You mean in terms of non-cash items? Again, gains or loss on disposal will be the other things that you would want to focus on. I think it's in that table that's on the slides. Can you highlight all the roll forwards and things we need to figure out in a different color, please? Again, it's going to depend on the information that you're given. I don't want to say you're always going to have to figure out what this the depreciation is because you may be given that number but not given purchases. So you just need to know how to do the roll forward. and I just need to figure out where I made my mistake here. So I'll take a minute and do that in 1 second. What's the formula for calculating PP&E if we aren't given them directly and need to calculate it for the cash flow? Again, you can use this roll forward, and if you know the sales, you know the depreciation, you know gains or losses, you can plug in purchases. Just solve for X, do algebra. It's right there. Would you ever roll forward inventory? I mean, for purposes of the cash flow statements and what you have to do, you can just take the change off the balance sheet, so you wouldn't have to worry about inventory. Any other questions? I'm kind of 40 minutes over, so I have to figure out where I did my formula wrong here on the PP&E, but I'll repost this file so you can see, and I really appreciate the person that pointed that out to me. And the purchase is definitely 25 on here. I know that's the right number. But let me figure that out real quick, and I'll repost it and make sure that everybody has the right information. I think I just have the wrong number under sales, but let me double check that. And I will get that back to you. But I think the professor also posted a roll forward, or he will be posting a roll forward for PP&E. So let me know if if you still have questions after that. Yes, the mistake is that this should be negative, I think. Does that work? Yes, that works. Thank you so much, who was that? Jacob, thank you so much. You're right. I absolutely did that incorrectly. I forgot to make that negative. I'm like, why is that not working? But that's absolutely why. Remember, we're going to subtract sales because it's reducing our PP&E amount. Thank you so much, Jacob. I really appreciate it. So now that should work. That should equal 50. So you're going to add purchases, subtract sales, subtract depreciation, add gains, subtract losses. So let's say someone had said, well, how do you find purchases? Let's say the 17,000 was given to us as part of the additional information. Then you just solve for purchases because you've got all the other pieces. So there's the answer. Thank you so much, Jacob. So in additional information, if the depreciation expense is given, then does it include everything in it, or would we have to make adjustments to it based on sales? No, you would just, if the additional information included depreciation, just put that number in your roll forward. Don't recalculate anything. In this problem, you don't know that, so you have to calculate it. But if it's given to you, just put that number for depreciation expense in your roll forward. The file will be posted. I'll create a file that says review slides, and I'll put this file in the review slides in that folder with the slides that I went over. So now I think the PP&E works because I subtracted the sales. So I think that's fine. Roll forward means you can take the beginning balance, account for all the changes in the activity, and that should give me the ending balance. So that's a roll forward. I should be able to take whatever is my prior year balance, compare it to the current year, and perform a roll forward to reflect all the changes that have happened. That's just a term that's used in accounting. You can roll forward any balances. How do you figure out a missing number if you're not giving it? Well, set up an algebra problem, right? So this would be, if you take the sum of all these things, it should equal the ending balance. If I'm missing one of them, make that X and solve for X. So that's how I would, so if I wasn't given depreciation, I would take my beginning balance, add 25, subtract 5, subtract X, add 0, subtract 0, and that should equal 50, and then solve for X. So it's just a basic kind of algebra problem. That's how I would do it. No problem. I hope that was helpful. Sorry, that cash is a little hard to go through online, so hopefully that was helpful to you guys. I think we got one last question. In reviewing for the test, do you think we should focus more on homework or review exams? I mean, the concepts are in the homework, but I mean, you have to know how to answer them in terms of multiple choice questions. So, I mean, if the homework helps you with the concepts, I would go through that. But if you struggle with how to solve multiple choice questions, I would practice with the multiple choice. Again, the multiple choice sample exams don't include everything. So don't just study that and think you're good. There could be other things on there that aren't covered in those exams. So, make sure you understand the concepts. There's example multiple choice questions in each of the chapters, too, that you can go through. Can you post all of the formulas that you used in this example? I'm not going to go through and post them for you. You should be able to hopefully follow along with what I had done. Again, just what I had said. You take the beginning balance, add purchases, subtract sales. It's listed right here in the text here. Tells you what to do, and that should equal your ending balance. So that should give you the formulas that you need. Again, that's just, it's right there in this file, and I'm going to post this file, so I'm not going to write out every formula for you. So hopefully that was helpful. I know I didn't get through the examples that somebody had wanted to do on bad debt expense and bond amortization. I'll post an example problem of those, but you're going to just have to give me a little bit of time. I might not get to it till this evening or tomorrow morning, but I'll definitely do that. And I'll post my slides in this file now so that you have it. And I'll also post the sample exam answers if that hasn't been done already. So hopefully that was helpful. If you have any questions, please let me know. If I don't respond to you within an hour, though, I'm not going to be sitting at my email all weekend waiting for you guys to email me questions, but I'll try and get back to you within a reasonable amount of time and help you with any other questions that you may have. You should be able to get my email from Blackboard. I've posted many announcements on Blackboard, including one yesterday about number 2 on the sample exam, so you should be able to see it there. Okay? Hopefully that was helpful. 45 minutes past my time, so I'm gonna log off. But please, any questions, I'll do my best to try and answer you the best that I can. Okay. Good luck, everyone, and I hope you all do awesome on the exam. Have a great weekend and study hard.